Good afternoon, ladies and gentlemen, and thank you for attending our OIC webinar on Volatility Strategies. My name is Ken Keating, and I'm a senior instructor here at the Options Industry Council. Just to give you a quick background on myself before we get started, I've been involved in options and options trading, managing risk for over 25 years. I started out on the floor of the Pacific Coast Stock Exchange in the early 90s. I was a floor market maker. I soon moved to Chicago, where I worked as a floor market maker as well as a floor specialist. I've managed off-floor prop books as well as risk management desks. I traded for myself for many, many years as a sole proprietor, and I worked for a period of time as an equity and derivatives analyst as well. So currently I've been working at the OIC helping individuals such as yourselves to better understand the risks and benefits of exchange-traded options. So on that note, one thing we have to get out of the way before we get started, we always have to mention the disclaimer. Options do involve risks and are not suitable for everyone. In order to simplify the calculations today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. All right, a little bit about the OIC. Who exactly is the OIC? Well, the OIC, the Options Industry Council, we are the education arm of the OCC, our parent company. The OCC is the world's largest equity derivatives clearinghouse for exchange-traded options and the foundation for secure markets in the United States. So we started out in 1992 as a collective, and now we are fully funded by our parent company, the OCC. So that's how we can offer free and unbiased professional options education. So we have no hidden agenda. We're not here to sell you on a subscription or courses. Everything is free, and we do that primarily through our website, optionseducation.org. There you'll find online courses, podcasts, videos, and webinars. We're actually in the process of revamping our education curriculum. So in the coming months, you will see a brand new course curriculum in terms of options education. So certainly be on the lookout for that. And once again, you can always access us at Options at the OCC with any and all of your options-related questions regarding this presentation or any others. All right, here is one of my favorite charts. This is annual options volume since 1973. Options started trading in 1973 on the Chicago Board of Options Exchange. The very first day we traded around 973 contracts. You contrast that today, on any given day, we're trading about 15 to 18 million contracts a day on average. Now, 2020, as you've probably all experienced, we've had tremendous volatility in the markets. And I know 2020's numbers aren't up here, but we've been averaging just shy of 29 million contracts a day in 2020. So you can see that 2018 was a record year for OCC, where we cleared and settled 5.2 billion contracts. If we were to stop trading today, we would have already exceeded that number. I think we're around 5.4 billion contracts with another whole quarter to go. So certainly no lack of investors using options to position as well as hedge themselves with the unprecedented volatility we've witnessed so far this year. Okay, here are the US listed options exchanges. These are the 5 main parent exchanges. These are where your orders are routed to when you execute, when you buy and sell your options: the BOX, the CBOE, MIAX, NASDAQ, and the NYSE. All right, so this is today's presentation outline. First, we're going to talk about the long straddle and the long strangle strategy. Next, we're going to look at the short straddle versus a similar but very different strategy, the iron butterfly. Then we're also going to look at the short strangle strategy versus the short iron condor strategy. So we'll be looking at choosing strikes and expirations, as well as profit and loss calculations and managing positional risk at expiration. So Q&A will be conducted along the way. My colleague Mark Benzaquin is behind the scenes answering your questions in real time, so certainly make use of that feature. You can click the Q&A box at the bottom of your screen and ask any questions you want related to this presentation today. All right, so let's get started. The long straddle and the long strangle. So the long straddle. A long straddle essentially is a position that's looking to take advantage of a potentially large market move, either up or down, and as well as a rise in implied volatility. So this combines the naked long call with a naked long put using the same month as well as the same strike. So when we put on this position, we are limited, our risk is limited to the amount of premium that we paid for this straddle. And our reward, we have unlimited upside reward, and we have limited downside reward to zero. So theoretically, stocks can go to infinity. So I've yet to see a stock go to infinity, but I've certainly been on the wrong side of a stock that is going up and it feels like it's going to infinity. But with a long call, you get participation theoretically unlimited to the upside. With the long put, you have limited downside participation all the way to zero. If a company ended up going, declaring bankruptcy, you have participation all the way down to zero. So why would somebody put on a long straddle? Well, you put on a long straddle when you're trying to time, a possible, binary event. Maybe it's an earnings event. Maybe you think a company is about to pre-announce good or bad earnings. Maybe there's a possibility that the CFO might step down. Maybe it's a biotech stock and it has a phase 3 trial that's pending and the stock's going to make a move 50% either way. So all situations you might consider using a long straddle. So anytime we are long options, we are long, we have theta, which is working against us. So every day, those options decay a little bit every single day the stock doesn't move. So as we get closer and closer to expiration, that theta gets greater and greater. So theta doesn't decay in a linear fashion. Theta decays more exponentially, and it's greatest as we get closer and closer to expiration. So when we're long options, theta is actually working against us, as is a decrease in implied volatility. So if we put on a long straddle and implied volatility goes down, that's actually going to hurt us. So I'm not going to get into a long discussion on implied volatility. We could actually speak for the whole hour on implied volatility. And we do have videos and webinars that we have done on implied volatility. But what I can tell you is, and I always tell people this, and I think it's really important, that implied volatility is probably the most misunderstood but crucial aspect of options trading. So if you really want to be good at options trading, you're going to have an understanding of implied volatility and what it is. So I'm just going to give you a 30-second breakdown of implied volatility. So options are forward-looking instruments. They're trying to predict how volatile a stock will be in the future. So, and when traders speak of implied volatility, all they're really referring to is the level of options prices. So when you see the pundits on TV talking about vol or implied volatility, what they're really talking about is options prices. So when implied vol is high, it implies that options prices are high and options are very expensive. And when implied volatility is low, it implies that options prices are on the lower end and less expensive. So when I was on the trading floor, I'm standing in my pit with the guys I'm trading with. We would never talk about, I bought this straddle for $5 and I sold this strangle for $3. We would always talk about trades in terms of vol. So I bought a 30 vol, I sold a 50 vol, or I bought a 40 vol and I sold an 80 vol. So when traders speak about implied volatility, what they're really referring to are options prices. All right, so the long straddle. We already mentioned that the long straddle is the purchase of one call option and the purchase of one put option, same underlier, same expiration, same strikes, typically at the money strikes. So if a stock we're trading right around 87.5, and we look out on our options chain and we see that we could buy 187.5 call and 187.5 put, even though technically we'd be long two contracts, one call and one put, traders would say, well, I'm long one Jan 87.5 straddle. So let's look at a long straddle example. So our fictitious stock is trading 87.5. We see that we can buy the 45-day 87.5 straddle for $4. So maybe we could buy the call for $1.90. Maybe we could buy the put for $2.10. So we're paying $4 for the straddle. So our maximum gain on this position is theoretically unlimited. We have downside participation to 0. Our maximum risk in this situation is the amount of premium that we paid. So we paid $4 for the straddle. So our maximum risk is $400. So 100% of our net investment. What are our break evens? So if the stock were to go up or down by $4, so you take the premium that we paid for that straddle, add it to the 87.5, you get to 91.5 on the upside. And you take the premium that we paid and subtract it from the 87.5, that gets you to 83.5 on the downside. So with the stock trading at 83.5 or 91.5 at expiration, we would neither make nor lose money. Somewhere in between, we would actually lose money, and outside of those prices at expiration, we would actually make money. So here is it's always easier to look at these in graph form. So here's the long straddle. So we buy 187.5 call for $1.90. We buy the 87.5 put for $2.10. We paid net $4 for the straddle. So ideally, we want the stock to move. So at expiration, if this stock is right at 87.5 at expiration, both the call and the put would expire worthless and we'd lose our entire investment. But that's all we'd lose. We can't lose more than the amount that we paid for the position. Our break evens on the downside, 83.5. Our break even on the upside, 91.5. Anywhere outside of that, stock goes to 60 or 105, we would actually make out very well on this position. So one thing to also think about, I talked about implied volatility. So this is something to think about. Now, I know we put this position on when we're looking for a huge move either way, but let's say we bought this straddle and we paid $4 for it, and tomorrow implied volatility goes up by 20 points. So this straddle, even with the stock not moving, this straddle is going to be trading higher. Maybe it's trading for $4.50. So in theory, if implied volatility goes our direction, we could actually make money on this straddle and without the stock even moving. So it's just to point out that implied volatility is a big factor. Also on the other side of it, if implied volatility were to go down 10 or 20 points, we would actually lose money with the stock trading in the same spot. So just know that implied volatility is a huge factor if we are long or short options. So now let's take a look at what is known as the long strangle. So a long strangle is similar to a straddle, but instead of using the same call and put, we're going to use different calls and different puts. So we're going to use the out of the money call combined with a naked out of the money put using different strikes, same month. So once again, this stock or this options position would be profitable if the stock makes a sharp move either up or down. Our risk is always limited to the debit or premium that we paid for this strangle. And this position will actually cost us less because we're not paying so much in time premium. Now, instead of buying the at-the-money options, we are purchasing the out-of-the-money options, so they cost less, but we would actually need a greater move in the underlying to be profitable. So, once again, we pay less, but we need a greater move. So it's something to consider. Volatility is also going to be a big player with this position. So a huge move in volatility to the upside would help us, and a volatility move down would hurt us. And once again, since we are long options, theta is not our friend and time is working against us in this position. So let's take a look at the long strangle example. So now we have our stock, it's still trading 87.5, and we look out at our options chain and we see that we can purchase the 90 call for $1.20. We can also purchase the 85 put for $1.30. So this is a net debit of $2.50. So our maximum gain, once again, since we're long options, we have unlimited gain to the upside, theoretical limited downside exposure to 0. Our maximum risk is always going to be the debit that we paid for that position. So 250 per strangle, 100% of our net investment. Our break-evens are going to be the debit that we paid plus the call, so 92.5 on the upside, and then you take the put price and you subtract the debit that we paid, so that gets you to 82.5 on the downside. So with the stock trading 92.5 or 82.5 at expiration, we would break even. We would neither make nor lose money. So once again, buying the strangle, buying the 90 call, buying 190 or buying 185 put, even though we're purchasing two options, we would say that we're just long 190, 85 strangle in this case. So it's always sometimes easier to look at things on a graph. So here is that long strangle on a graph. So as you can see, with the stock trading anywhere between 85 and 90 now, our both options at expiration would expire worthless. So we really want this thing to move. Remember on the straddle, we paid $4 for the straddle and our break even was 83.5 on the downside and 91.5 on the upside. So now you can see with the strangle, we paid $2.50 for the strangle, but now we need $1 extra move in either direction, 82.5 on the downside, 92.5 on the upside to break even. So just pointing out that we're paying less, but we need a greater move in the underlying for this position. And once again, we're only going to put on this position if we think that the options market is implying, or we think there's going to be a greater move in the underlying than what the options market is implying. All right, so that's the long straddle and the long strangle. So now let's take a look at the short straddle versus a very similar but different position, the short iron butterfly. All right, the short straddle. So it's just the opposite of the long straddle. So we're looking to put this position on because we want to take advantage of a neutral to range bound security. So we think implied volatility or options prices are really high, they're expensive. But we think the stock is not really going to move, or if it moves, it's going to move down a little, it's going to move up a little, it's just going to be range bound. And we're also looking for a fall in implied volatility. So in this position, we would combine a naked short at the money call with a naked short at the money put, same strike, same month. Now, you don't have to use the at the money. Some traders might choose to use, a deeper call or a deeper put, take a directional bias. But typically, when traders are, especially when they're sell options, they're trying to target the at the money options, because when option prices are high, the at the monies have the most time premium in them, and that's what traders are trying to target, is the time premium in the option. So generally speaking, if all were high and a trader were looking to sell a straddle, they'd be looking at the at the money options. So selling one naked short at the money call, one naked short at the money put, same month, same strike. Once again, this will be profitable if the stock stays range bound around the short strikes. We have unlimited risk now to the upside, as well as downside risk to 0. So anytime you're naked short options, you have considerable amount of risk. We do this in return for that risk that we take on, we are creating income. So we get to keep a certain amount of premium for selling that straddle, for assuming that risk. Now, since we're short options, time is on our side and it's our friend. So every day that stock doesn't really move and we get closer and closer to expiration, that straddle is going to decay a little bit every single day. a decrease in implied volatility in this case will also help our position. So if we are short a straddle and implied volatility gets crushed tomorrow, we're going to do really well because that straddle is going to be worth less than what we sold it for, today or, yesterday or whenever we sold the straddle, and we could potentially buy back that position at a cheaper price. So here is the short straddle example. So now we have sold the 87.5 call for 190. We sold the 87.5 put for 210. So we've taken in a $4 credit. So anytime we sell options, the most we can make is the credit that we receive. So in this case, $4 per straddle. Our maximum gain is the amount that we took in, $400. Once again, maximum risk, unlimited theoretical upside risk through the short call. Downside risk is 0 through the short put. Our break evens, once again, are 83.5 and 91.5 to the upside. So here's that short straddle in graph form. So, once again, it's the mere opposite of the long straddle. So now, with the stock right at expiration at 87.5, theoretically at 87.5, both call and put expire worthless. So let me ask you this. If we put this position on and we sold this straddle for $4 and maybe it's expiration, the stock is trading, 87.5, 87.40, what is the likelihood that this stock is actually going to close right at 87.5? It's pretty low. It could happen, but it's pretty low. So if it closes at 87.5, both options would expire worthless, and you would keep the full credit of $4. But keep in mind, anytime you are short options, and this is very important, anytime you're short options, you have assignment risk. And if that stock closed at 87.5 at expiration, there's nothing to say that somebody who's long the 87.5 call, even though theoretically it's worthless, won't decide to exercise it. And if that happens, you would be assigned and you would wake up on Monday morning short 100 shares in this particular issue. Likewise, on the put side, if you were to get assigned on your 87.5 put, you would wake up on Monday morning long 100 shares. So to mitigate that risk, most traders who would sell the straddle on expiration, if they could buy back their straddle for 20 cents or 10 or 20 cents, they would do it and just lock in that the majority of that credit and not have that assignment risk. So once again, the only way to truly avoid assignment risk is to purchase back your short options. Once you purchase back those short options, you are no longer under any obligation to buy or sell shares of stock. So that is the short straddle. So, obviously, as we looked at it, there's considerable risk, and traders generally don't like to take risk. So we're going to look at the iron butterfly as an alternative to just being naked short a straddle. So before we talk about the iron butterfly, we're going to look at what is a traditional butterfly. So a regular butterfly typically is either all calls or all puts. It consists of three option series, and the strikes are equal distance apart, and typically it's always done for a net debit. So on the call side, it's either the combination of a bull call spread and a bear call spread, or a bull put spread plus a bear put spread plus a bull put spread. So you can think of it as a debit spread plus a credit spread on either, and the short strikes that you are selling with both spreads share the same strike. So that is a traditional butterfly. So why do traders like to do butterflies? Well, once again, this is a defined risk strategy, and the costs of butterflies aren't that much. Typically, if you're targeting the at-the-money strikes to be short, the trades end up being more market neutral. You are allowed, this is giving you the ability to sell high implied volatility or high options prices with limited risk. So when we sold that naked straddle, we have unlimited risk. Now, by putting on a butterfly, we can mitigate that and have some protection and sell high implied volatility without having that risk. And, you know, with a butterfly, you can always have a bullish, bearish, or neutral stance. If you were going to target, with a traditional butterfly, if you targeted the at-the-money strikes to be short, you'd be more neutral. If you purchased a out-of-the-money call butterfly, that would be more bullish, you know. And you could also take a bearish stance, a directional bearish stance, by purchasing an out-of-the-money put butterfly. But that's a traditional butterfly. So what we're going to look at is what is called the iron butterfly. So the short iron butterfly. So this is once again very similar to a regular butterfly. But now, instead of using all calls or all puts, we're actually going to use both. So we're going to combine now a short straddle with a long strangle. So it's the combination of selling an at-the-money straddle combined with a long out-of-the-money strangle. So you can also view this as selling a bull put spread and selling a bear call credit spread. And the short strikes that you're selling are the same on both the credit spreads. So, and because we're selling this, okay, now we're taking in a credit. So the maximum profit that we can make on this position would be achieved at the short strikes. We want that stock just to sit and do nothing, or at least, you know, move very little. We have limited risk up and down now because we have that long strangle to protect ourselves. So, and we're doing this once again because implied volatility or options prices are high and we're looking to generate a little income. And because we're selling those more premium heavy options, the at-the-money options, time in this case, or theta, is on our side and it's working for us, as is a flat or decreasing level of implied volatility. So let's take a look at a short iron butterfly example. So now we have our same fictitious stock. It's trading 87.5, and we look and we sell that 87.5 straddle for $4, and we combine it with the 85.90 strangle. So we're literally taking two separate options positions and combining it to make an entirely new position. So we sold the straddle for $4. We bought the strangle for $2.50. So that's a net credit of $1.50. So the most we can make on this position is $1.50 or $150 per iron butterfly. That's our maximum gain. The maximum risk is always going to be the difference in strike less the credit received. So the difference in strikes here is $2.50 minus the credit we received. So our maximum risk is $1. So one way to look at it is to think that you're risking $1 or $100 to make $150. So our break evens, we take the credit that we received and we can add it to 87.5, and that gets us to 89 on the upside. We take the credit we received and we subtract it from 87.5, that gets us to 86. So as you can see, our range to break even is actually narrower. Now with the stock at 86 or 89, we would break even. Anywhere in between, we would make money. And anywhere outside of that, we would, outside of our long strikes, we would actually lose the maximum, which is $1 in this case. So always, anytime you're short options, assignment risk is something to think about, and we will look at that in the next slide. All right, so here's the short iron butterfly example. So now, so we sold that straddle at $4. We bought the strangle for $2.50, a net credit of $1.50. So, you know, ideally we like that stock to close right at 87.5. So once again, if we put this position on and it's expiration Friday, and we've got a couple hours to go to the close, and stock's trading near 87.5. Many traders would just choose to close this down and not have that assignment risk. It's entirely up to you whether, if you think this is going to get pinned and you think both options are going to expire worthless, that's certainly up to you as the investor, but the likelihood of that happening is pretty remote. And to mitigate that risk, most traders would actually buy back at least their short options to alleviate any kind of assignment risk and lock in that profit. So as you can see, once again, sweet spot at expiration is right at strike. Our break even 86 to the downside, 89 to the upside, and then anywhere outside the below 85 or above 90, we would lose the maximum, which would be $1 in this case. So once again, the defined nature of this position of this butterfly only exists within the spread itself. So an exercise or an assignment would completely throw off the defined risk characteristics of this spread or any spread that you decide to put on. Okay, so let's look at the Greeks. So the short straddle and the short iron butterfly share many of the same Greeks. So if we're targeting an at-the-money options to sell, whether it's with the straddle or the iron butterfly, our deltas or our market exposure is going to be near neutral. Now, granted, we can structure these directionally, but if implied volatility is high, most traders would choose to be trying to sell those at-the-money options. And if we do, we're going to be near delta neutral. Anytime we are short options, we are going to have negative gamma. So gamma being the speed of delta. So when the underlying price rises, both positions become a little more short. And when the underlying price falls, both positions become more long. So, when the stock's rallying, we get shorter and shorter. And when the stocks are falling, we get longer and longer. So what does that tell us? Well, that tells us we don't want the stock to move. We want it just to sit and just be range bound. Moving up a little bit's fine, moving down a little bit's fine, but we don't want a big move either way because the gamma will hurt us. So negative gamma, and because we have negative gamma, that implies that we have positive theta, because since we're short those premium heavy at the money options, we will receive theta. Time decay is working in our favor. The extrinsic value of those options decreases over time as we get closer and closer to expiration, leading to a decrease in options prices. Also, a decrease in implied volatility is going to help us, meaning that we have a negative vega position. So with a short straddle or a short iron butterfly, we have a short vega position, which implies we want implied volatility to go lower because that will actually help us. A rise in implied volatility with a negative vega position will actually hurt us a little bit with either of these. All right, so let's talk about risk versus reward. I think it's pretty obvious, but no risk, no reward. The short straddle always offers the larger profit potential, but the higher max loss potential. The short iron butterfly, lower profit potential and a lower max loss potential. So this is why traders really like trading spreads. They like trading butterflies, iron butterflies, condors, iron condors. Actually, we'll get into the iron condor in the next few slides. But spreads are the reason why traders like trading them is because they limit your risk. So with both positions, the trading range to profit is going to be wider on the straddle because once again, you're taking in more, you're selling more premium. With the iron butterfly, remember, we're buying that out of the money strangle, so that is actually decreasing our credit, but it's giving us protection. So take in less credit, have protection, take in, keep the whole premium and have no protection. So, it all depends on your risk tolerance as a trader. Both positions also want implied volatility to go down, so both positions are short vega or implied volatility. All right, so now let's take a look at the short strangle and compare that to the short iron condor, also a very similar but different strategy. So, short strangle characteristics. Once again, anytime we sell options, we're looking to take advantage of a neutral to range-bound security and a fall in implied volatility. So now we're just going to combine a naked short out of the money call with a naked short out of the money put. Different strikes, same month. This position would be profitable if the stock stayed range-bound between the break-evens on this position. Once again, because we are naked short options, we have unlimited risk to the upside through the naked short call, and we have downside risk to zero through the naked short put. But we do this because we're getting income. We're doing this to target high implied volatility, and because of that, when we sell these options, we will generate income. And when we sell options, time is on our side as the options decay over time, as does a lower level of implied volatility. So here's the short strangle example. So we sell the 90 call for $1.20. We sell the 45-day 85 put for $1.30. So we take in $250. So that is the most we can make on this position. It's $250, the credit received. Our maximum risk, once again, is unlimited to the upside. Downside risk is zero. Our break evens, we take that credit that we received, the $250, we add it to the call strike, gets us to 92.5 on the upside. We subtract it from the 85 put, that gets us to 82.5 on the downside. So if the stock closed at 82.5 or 92.5 at expiration, we would neither make the money nor lose money. Anywhere in between, we would make money, and anywhere outside of those ranges, we would actually start losing money. So once again, if we sold the 90 call, we sold the 85 put, we did that one time, we'd be short 2 contracts, but traders would say, I'm short one Jan 90, 85 strangle. So here is the short strangle example. So here it is on graph form, so it's always easier to see it in graph form. At expiration, ideally we want that stock to close somewhere between 85 and 90. So now we have a range. It doesn't necessarily have to close right at strike. It can close anywhere in between, and both options would expire worthless. You see our break evens, 82.5 on the downside, 92.5 on the upside. So once again, if we put on the short strangle and we're expiration, most traders would choose to close this down if stock were trading 86 or maybe 87, just to alleviate that potential assignment risk. So sometimes, and this is really important, I know we have a range here, a $5 range. If the stock, let's say the stock did close right at 87.5. And both options are $2.50 out of the money, both the call and the put. And you think, well, there's no way. It's worthless. I'm just going to do nothing. Well, if some news comes out after the close, and this happens quite often, maybe stock goes up to 100. Somebody could exercise their what appeared to be an out-of-the-money call, and if you get assigned, you're going to wake up on Monday short 100 shares of stock. Likewise on the downside with the put. So stocks do move in the aftermarket, and once again, the only way to alleviate a potential unwanted assignment is to buy back your short options. If the stock closed, if you put on a bunch of these strangles 9 times out of 10, and the stock finishes between these strikes, 85 and 90, more often than not, those options are all going to expire worthless. But it's the 1 time in 10 that you don't cover your short options that it costs you dearly, because the stock makes a huge move in the aftermarket either way. So just something to think about when you put on these positions. All right, so now that's the short strangle. So now let's take a look at the short iron condor. So once again, the short iron condor is very similar to the short strangle. In fact, it's kind of like a butterfly, but more elongated. So the short iron condor is the sale of a call credit spread. So there's our short call credit spread. We're going to combine that with the sale of a put credit spread. There's our put credit spread. So it's the same underlier, same expiration month, both spreads employing out-of-the-money options. So it's selling an out-of-the-money bull put spread as well as selling an out-of-the-money call bear call spread. So when we put this position on, we're looking to take advantage of a neutral to range-bound security and a fall in implied volatility. So you can kind of think of a iron condor or short iron condor as the combination of two strangles. So now we're gonna, that short strangle in the first example had unlimited risk. Now we're gonna sell an inside strangle, the inside strangle, and we're gonna purchase an outside strangle for protection. So now, by combining the short strangle and a long strangle, now we don't have that unlimited risk to the upside or downside. We're not taking in as much of a credit, but we are protecting ourselves in the event that the stock moves either way. So once again, in this position, the stock or the position will be profitable if the stock stays range bound between the break-evens. Now we have limited our risk. The risk is the difference in strike less the credit we received. And once again, we're doing this to create some income. Theta is on our side. It's our friend because we have sold those more premium heavy options, and a decrease in implied volatility is actually going to benefit us in this position. So here we have a stock. Let's look at an example. So this is a different stock. Stock's trading 88.5, 28 days to go to expiration. And we think, okay, that the price range on the stock is around 85 to 90. Maybe we looked at a chart and it's in a trading range and we just expect it to be somewhat range bound, but implied volatility is on the higher end. So now we are going to sell, we see that we can sell the 90-95 call spread, okay, selling the 90 call, buying the 95. We can do that and take in $1.70. At the same time, we can sell the 85-80 put spread. So selling the 85 put, buying the 80 put. I'm sorry, selling the 85 put, buying the 80 put, and we can take in $1.35 by doing that. So when you do the math, the total for that trade, we take in a credit of $3.05 or 305 per iron condor. So as you can see, we're taking two credit spreads, combining them to make an iron condor, or one. We're taking two entirely different positions and making a third position, the iron condor. So you can see that we are selling the 90-85 strangle and we're purchasing the 95-80 strangle. So that's how you can see we're selling that inside strangle, purchasing that outside strangle. This is your typical iron condor. So now let's take a look at this. So same position. The most we can make on this position is the credit that we took in, the 305. The maximum risk in our case. So the difference in strike now is $5. So the $5 minus the 305 we took in is $1.95. So the maximum we risk is $1.95. So we can think of it as we're risking $195 to make $305. Our break-evens, our short strikes, okay, in this case, the 90 short call plus the credit we took in, the 305, gets us to 93.05 on the upside. On the downside, our short 85 put minus the credit that we took in gets us to 81.95. So anywhere with the stock at expiration at either of those prices, we would neither make money nor lose money. Anywhere in between those prices, we would make money. And anywhere outside those prices, we would start to lose the maximum 195, which would actually occur if the stock went to either of our long strikes, the 80 put on the downside or the 95 call on the upside. So let's take a look at this in graph form. So when we sell the 90-95 call spread, and we combine that with the 80-85 put spread for a net credit of 305, you can see the position right here. You can see the break-evens. So our break-even 81.95 on the downside, 93.05 on the upside. So, and just like the iron condor, just like the short straddle and the short iron butterfly, the short strangle and the short iron condor also share many of the same Greeks. So once again, using the more at-the-money options would give us more of a market neutral or delta neutral position. We're going to have negative gamma on both positions. We want that stock to sit. We don't really want it to move. And because we're short gamma, we're going to be taking in theta on both positions. So we're going to have positive theta. And because we're short the more premium heavy options, we're going to have a negative vega position. Risk versus reward. As you can probably guess, the short strangle, higher reward, higher risk. Short iron condor, lower profit potential, lower risk. The trading range to profit is always going to be wider with the short strangle. It's going to be narrower with the short iron condor only because we're paying for that outside strangle as protection, so it's going to cut down on the total credit we're taking in. So once again, more of a risk-defined strategy when we put on the short iron condor, giving us the ability to sell high implied volatility while limiting our risk. And lastly, both positions having short vega, meaning that we want implied volatility to go lower, which would benefit us on both positions. All right, so characteristics of spread, something to think about here. So once again, traders love trading spreads, whether they're debit spreads, credit spreads, butterflies, condors, iron butterflies. This is because it's lower risk than selling naked options. So once again, we have limited profit potential, but then also limited loss potential as well. Now, I know at the beginning of the presentation, we talked about, we weren't going to talk about commissions. I do have to mention, you know, in this day and age, trading stock is basically free now. Brokerages aren't really charging you to trade stocks. Options, however, brokers are charging you commissions. And when you do a multi-leg strategy like a iron butterfly or a condor that involves multiple legs, commissions may come into play and may be something to think about when putting on these multi-leg positions. So you'll certainly want to inquire with your broker as to their commission structure on spreads and multi-leg spreads. So anytime you have put on one of these positions, you always have a specific time and price forecast in mind. And with the iron condor, since we are short 2 credit spreads, okay, so we have actually 2 chances to get scared. So, you know, we really want that stock to trade within a very defined range. We don't want it to move either way. So with the iron condor, either of these could happen. So once again, the commission, something to consider, talk to your broker. Now, this is something to think about. What if the stock price is between strikes at expiration? Okay, so the stock, let's say the stock closes at 92.5. Okay, so you know it's below our break even, so we'd actually make a little bit of money. But if we did nothing with this position, okay, we would wake up on Monday morning and we would be short 100 shares. Because we would be assigned on our short 90 call, our 95 call would expire worthless, as would all of our puts. So same thing on the downside. If stock closed at 81, we would surely get assigned on our short 85 put, and our long put would expire, and we would wake up long 100 shares on Monday morning. And also, if the stock closed at, let's say the stock closed right at 87.5, and it appears that both options are going to expire worthless. So it's entirely up to you. Most traders, being risk averse, and I can tell you this from personal experience, I've seen too many things happen in the aftermarket. Most prudent traders would cover their short options for a nickel or a dime and not have that unwanted assignment risk. So once again, entirely up to you, but anytime you're naked short options, or short options, whether it's in a spread or just naked short options, you do have assignment risk. And once again, with the iron condor, either of the above could happen. All right, so let's go over some key points. Long straddles and strangles are defined risk strategies used to take advantage of an outside move in the underlying, okay? Short iron butterflies and short iron condors are defined risk strategies to sell high implied volatility or to take advantage of a range-bound underlier. And always the most risky trades are short straddles and strangles are undefined risk strategies to sell high implied volatility or to take advantage of a range-bound underlying. There's always increased risk or potential for profitability, but there's also, with that increased profitability comes with increased risk. So not to say that traders won't sell straddles or strangles, but just understand that they are the most risky strategies. All these positions can be constructed directionally, both bullish, bearish, or neutral. And lastly, early assignment can change the risk profiles of these strategies. And not only an early assignment, an exercise. So once again, getting back to that point that the defined nature of a spread, whether it's a debit, credit, butterfly, condor, you name it, it only exists within the spread itself. So an early assignment or an exercise situation, if you decide to exercise, will absolutely throw off the defined nature of these strategies. So that is our presentation. I know we have a little time. I know Mark's been answering a lot of questions along the way. Let's take a look and see if there's any questions that we can address here. Let's see. See how to manage spreads, especially the tested side. Okay, so sometimes if you have a butterfly and it tests you on, it goes through your short strike. Some traders will roll the untested side up to take in more premium. Now that's entirely up to you, because now you have a new defined range that you're putting on. Now you're taking in more premium by doing that, by rolling up the untested side. So if the stock, if you have a butterfly on, and or let's say you have a condor on and the stock rallies through your short strike, you might roll up the untested put strike or put spread to take in more premium, and hope that option or that stock rolls over a little bit. Certainly, depending on what the stock does, anytime you're in the market, your forecast and motivation is constantly changing on a daily basis. So, what you thought yesterday might change tomorrow based on news or, new technicals on the stock, whatever, demand for options, you name it. So this is always changing. So you can always roll the untested side up. That's something to consider. Let's see, there's another question. Is it better to use stop losses or hedge with the underlying? Well, once again, if you have, if you're a delta neutral trader and you're selling naked options, obviously, you can hedge with the underlier. Typically, that's more reserved for professional traders. Generally, you can use options as a stop loss. This is why people like to trade spreads more, is because of the defined nature. So you don't have to think about having to hedge. You've already defined that risk up front, and but certainly you could use the stock to hedge, but that's, like I said, that's more reserved for professional traders. Let's see. Somebody asked, will there be a recording available? That's actually one of the most popular questions we always get. At some point in the next 24 hours, you will get a copy of this presentation. You'll get a link that will give you access to this presentation, so you can view it at your convenience. You can also download the PDF by clicking the Resources List tab and have a copy of the PDF. let's see, look at some of these other questions. Can an out-of-the-money option be assigned? Okay, well, once again, anytime you are short options, American-style options, you can be assigned on or before expiration for any reason possible. I can tell you a little story, and this is, I can't mention the stock, but this was a few weeks ago, and many traders they were short credit spreads, credit put spreads. So they were maybe long like a 400 put and short 410 put. And this stock closed, I think it was around $418. And in the aftermarket, the stock dropped down. This is on expiration. The stock dropped $20. So options that were $8 out of the money got assigned. People decided to exercise their out of the money puts. And this is that gap risk. So once again, the only way to truly avoid an unwanted assignment is to cover what appears to be out of the money options, so you don't have to deal with that. Also, on the flip side, if somebody had a debit spread, a call debit spread with the stock trading 418, let's say you had the 400, 410 spread on, call spread, and you think, okay, my spread's worth $10. I'm going to exercise my 400s and be assigned on my 410s. Somebody could choose to not exercise an in-the-money call. So on Monday morning, if you exercised your 400s and somebody chose not to exercise their the 410s that you're short, you're going to wake up on Monday morning and you're going to be long stock. And if the stock gaps down in a big way, which this particular stock did, that's going to be a problem. So once again, you know, anybody who's long options, if you're long options, you always have the right to exercise an out-of-the-money option if you so choose, as well as not exercise an in-the-money option. So, and getting back to that defined nature of these spreads, the defined nature of a spread only exists within the spread itself. And that's really important to understand. So, and the only way to alleviate unwanted assignment risk is by purchasing back those short options. So I think that's about it. I think Mark answered many of the questions. I really appreciate your time today. If you have any more questions, you can always reach out to us at options@theocc.com. Questions related to this presentation or any question you have in general about options. You can certainly check out our website, optionseducation.org, for more resources. You can check out our YouTube channel. The OIC has a YouTube channel where we archive many of our past webinar events. So if there's a topic you'd like to study more, whether it's implied volatility, historic volatility, debit spreads, credit spreads, straddles, strangles, covered calls, cash secure puts, we've done multiple videos on just about any topic you can think of related to options. So that's our presentation. I just want to say thank you for joining us. Please join us next week on October 21st as Dan Kerrigan, the current president of NASDAQ Futures, will be presenting option strategies to potentially generate income, where he'll be looking at the covered call strategy as well as the cash secured puts. So certainly sign up for that if you have interest. So with that, I hope everyone has a great afternoon. Stay healthy, and we look forward to seeing you next week.